Imagine this. Bitcoin is pushing towards $73,000. Momentum is building. Retail traders are piling in. Liquidation levels are stacking above the market. Then suddenly, the price collapses. Billions of dollars in leverage disappear within hours. The breakout fails. Bitcoin drops thousands of dollars almost instantly. At first glance, it looks like normal market volatility. But when analysts started digging into the trading flows behind the move, a familiar name kept appearing. A firm most retail investors have never heard of. A firm that quietly moves billions of dollars every single day. A Wall Street trading giant called Jane Street. And that raises a fascinating question. Did Jane Street just move the Bitcoin market? Before we go any further, if you're someone trying to understand where real wealth is built and protected in a market like this, stick around until the end of this video, because I'm going to show you something about how sophisticated money actually operates that could completely change how you think about your own financial strategy. Like if you've ever wondered who's really on the other side of your trade. Let's start with what actually happened. Bitcoin hit its all-time high of $126,000 in October 2025. That was the peak of a cycle that started in early 2024, fueled by the approval of spot Bitcoin ETFs, massive institutional inflows, and a post-halving supply squeeze. And then something changed. November 2025, red month. December 2025, red month. January 2026, red month. February 2026, down another 15%. That's 5 consecutive losing months for Bitcoin, starting from the very top. Today, March 7th, 2026, Bitcoin is trading around $67,000 to $68,000. Its market cap sits at approximately $1.33 trillion, and the Fear and Greed Index, the gauge that measures whether the market is in euphoria or panic, is sitting at 22, extreme fear. So what broke the momentum? On the surface, you've got several explanations. Trump's global tariff announcements hammered the S&P 500, and Bitcoin's correlation with equities is now sitting at 0.55, meaning when stocks sneeze, Bitcoin catches pneumonia. US-Iran military escalation added another layer of uncertainty. Gold, the old safe haven, surged over 80% in the past year to $5,180 an ounce, while Bitcoin bled. Capital rotated out of risk assets, out of crypto, out of everything speculative. But here's what they're not telling you. That doesn't explain the pattern. The geopolitical tension doesn't explain why Bitcoin dropped specifically, mechanically, at exactly 10 a.m. Eastern Time every single morning, like a timer had gone off, liquidating long positions with surgical precision before recovering. Macro doesn't trade on a timestamp, fear doesn't have a schedule, but algorithms do. Stay with me until the 9-minute mark, because what I am about to show you about how modern Bitcoin markets actually function, who controls the liquidity, who controls the price discovery, and what one firm's legal troubles in a federal courthouse in Manhattan may have accidentally revealed about all of it, is something most retail investors will never understand. And that information gap? That's costing you money right now. Comment below, are you currently holding Bitcoin, buying the dip, or waiting on the sidelines? Here's what you need to understand before we go any further. Bitcoin in 2026 is not the Bitcoin of 2017. In 2017, retail traders dominated this market. Cryptocurrency prices were driven almost entirely by retail speculation. Individuals buying on exchanges, hype cycles, Reddit threads, Telegram groups. The market was raw, unstructured, and violently volatile. But it was at least honest in one sense. The price moved because regular people were buying and selling. That world is gone. Today, the Bitcoin market is dominated by 3 structural forces that most retail investors don't fully understand, and that's where the real story begins. Force number 1, ETF issuers. In January 2024, the SEC approved spot Bitcoin ETFs in the United States. BlackRock launched IBIT, the iShares Bitcoin Trust. Fidelity launched FBTC. Within months, billions of dollars began flowing into these products from pension funds, wealth managers, family offices, and retail investors through their brokerage accounts. Total assets under management across spot Bitcoin ETFs reached tens of billions of dollars. Force number 2, institutional market makers. ETFs don't just run themselves. For every share of IBIT that gets created or redeemed, someone has to actually go into the market and buy or sell the underlying Bitcoin. These are called authorized participants, APs, and they are the firms that sit at the most powerful structural position in the entire Bitcoin ecosystem. Force number 3, derivatives, trading firms. Bitcoin's derivatives markets, the futures, the options, the perpetual swaps, now dwarf the spot market in daily volume. These markets create leverage, and leverage creates liquidations. And liquidations create the kind of violent, sudden price moves that wipe out retail traders. Here's the critical thing to understand. These 3 forces are not separate. They are interconnected. And one firm sits at the intersection of all three. You need to understand this before I show you what's next. Because the mechanics I'm about to walk you through are the exact mechanics that determine whether the price of Bitcoin goes up or down on any given morning. And most people watching this right now have no idea they exist. Subscribe if you want to understand how institutional money actually moves, not just in crypto, but in every market. Let me introduce you to Jane Street. Jane Street Group is a quantitative trading firm headquartered in New York City. It was founded in 2000. Today, it is one of the largest trading firms on the planet, operating across stocks, bonds, currencies, commodities, derivatives, and yes, cryptocurrencies. Jane Street doesn't manage client money the way a hedge fund does. It doesn't run a mutual fund. It doesn't show up in the news talking about investment strategy. What Jane Street does is provide liquidity. Think of liquidity as the oil that makes financial markets run. When you buy a share of Apple stock, someone on the other side sold it to you. That someone, more often than you'd think, is a firm like Jane Street. They sit between buyers and sellers, making markets, taking tiny spreads, and doing it millions of times a day with algorithmic precision at speeds measured in microseconds. Jane Street's revenue in recent years has been staggering. The firm reportedly generated billions of dollars in trading revenue annually, making it one of the most profitable firms per employee anywhere in the financial world. But here's what makes Jane Street's position in the Bitcoin market extraordinary. Jane Street is one of only 4 authorized participants for BlackRock's iShares Bitcoin Trust, IBIT, the world's largest spot Bitcoin ETF. The other 3 are Virtue Americas, JP Morgan Securities, and Marex, just 4 firms. That's it. 4 firms that hold the structural power to create and redeem IBIT shares, meaning they are the only entities that can directly add or remove Bitcoin from the largest institutional Bitcoin wrapper in the world. And Jane Street is the biggest of the 4. As of Q3 2025, Jane Street held $5.7 billion in IBIT shares. In Q4 2025, it added another $276 million, 7.1 million new shares, bringing its total position to over 20.3 million IBIT shares, worth approximately $790 million at year-end prices. That number went viral in crypto communities in February 2026 when the 13F filing was released, because some people started asking a very uncomfortable question. Why is a firm that's allegedly been selling Bitcoin every morning at market open simultaneously accumulating the largest position in the Bitcoin ETF market? And that is where the story gets very, very interesting. Where are you watching this from? Drop your country in the comments. Stay with me here, because what I'm about to explain is the mechanism that connects everything. This is the part that analysts are obsessing over right now, and once you understand it, you'll never look at a Bitcoin price chart the same way again. Here is how spot Bitcoin ETFs actually work. When you, as an investor, go to your Fidelity or Schwab account and buy shares of IBIT, BlackRock's Bitcoin ETF, you're not buying Bitcoin directly. You're buying a share that represents a claim on Bitcoin held inside a trust. So where does the actual Bitcoin come from? This is where authorized participants, firms like Jane Street, enter the picture. The creation process works like this. When demand for IBIT shares exceeds supply, an authorized participant steps in. The AP either delivers cash or, since the SEC approved physical creation in September 2025, delivers actual Bitcoin directly to the trust. In exchange, the trust creates new IBIT shares and gives them to the AP. The AP then sells those shares to investors in the open market. The redemption process is the reverse. When investors want to exit, the AP buys up IBIT shares, delivers them back to the trust, and receives Bitcoin or cash in return. Here's the critical insight. In a purely cash creation model, which was the original structure, the AP didn't need to touch actual Bitcoin during creation. They could hedge their Bitcoin exposure using futures or other derivatives. This means the creation of new ETF shares didn't necessarily require buying spot Bitcoin at all. In other words, the price discovery in the spot Bitcoin market could, under certain conditions, be partially disconnected from ETF flows. And the firms with the most sophisticated tools to exploit that disconnection? You guessed it. The authorized participants. Jeff Park, Chief Investment Officer at ProCap and an advisor to ETF issuer Bitwise, has pointed out publicly that this debate reflects widespread misunderstanding of ETF market structure. The creation and redemption process allows institutional middlemen to meet demand without necessarily buying or selling Bitcoin on public exchanges. But here's what they're not telling you. That same structural advantage, that same privileged position inside the plumbing of the Bitcoin ETF system, could theoretically be used in ways that benefit the AP far beyond a simple liquidity spread. And the theory that emerged in November 2025 suggests that's exactly what might have been happening. This is where it gets really concerning. Beginning in early November 2025, traders started noticing something that couldn't be explained by normal market dynamics every single morning. At approximately 10 a.m. Eastern Time, the moment the U.S. stock market opened, Bitcoin would experience a sharp, sudden sell-off. Not a gradual decline, a spike in selling pressure, a cascade. Leveraged long positions would start liquidating. Panic would spread. Bitcoin would drop hundreds of dollars within minutes before gradually recovering into the afternoon. Charts from December 2025 show a concrete example. Bitcoin dropping from $89,700 to $87,700 within minutes. That move wiped out 171 million in long positions in a single morning session. The pattern was so consistent, so mechanical, so precisely timed that traders immediately suspected algorithmic activity. Milk Road, one of the most widely read crypto publications, described the alleged pattern in detail. Around 10 a.m. Eastern, large sell volumes hit Bitcoin and related ETF shares simultaneously, creating panic, triggering liquidations of leveraged long positions, and exploiting thin liquidity pockets at market open, a time when bid-ask spreads are wider and the market is most vulnerable. Then, the same institutions allegedly buy back at lower prices. This pattern became known in crypto communities as the 10 a.m. morning massacre. Now, does this constitute manipulation? Here is where you need to think carefully. The legal definition of market manipulation is not simple. Trading firms are allowed to buy and sell assets for their own account. Market makers are, by definition, in the business of moving large amounts of capital at precisely the moments when it's most advantageous for them to do so. But analysts have made a structural observation that's harder to dismiss. When an authorized participant holds a massive position in the Bitcoin ETF and simultaneously holds the infrastructure to create and redeem those shares, and when its algorithms consistently generate selling pressure at the moment the spot market is most thin, the question is not just legal, it's architectural. The question is, has the Bitcoin market been structurally engineered to transfer wealth from leveraged retail traders to the institutional firms that sit inside the ETF plumbing? And the answer, whether it's manipulation or not, might be yes. Michael Green, a former hedge fund manager and widely respected market structure analyst, noted publicly that Jane Street's IBIT position shown in the 13F is almost entirely offset by undisclosed options on IBIT and futures positions. In other words, what you see in the filing isn't the full picture. The net exposure of a market maker is far more complex than a single line item. Think about that. The filing that went viral and sent the theory mainstream may only be showing you a fraction of the actual position. What's the rest of the picture? That nobody outside Jane Street knows? Hit like if this is giving you a completely different perspective on how these markets work. Here's where the story takes an extraordinary turn. On January 23, 2026, a lawsuit was filed against Jane Street in federal court in Manhattan. The plaintiff is the administrator of Terraform Labs, the company behind the catastrophic Terra USD and Luna collapse in 2022, which erased $40 billion in value and sent shockwaves through the entire crypto market. The core allegation? Jane Street used material non-public information to withdraw its liquidity from the Terra USD ecosystem immediately before the peg broke, effectively knowing the crash was coming before the market did, and positioning accordingly. Jane Street has strongly denied the allegations and called the case meritless. But here's what happened next. And this is the part that blew up on crypto Twitter. After news of the lawsuit began circulating widely on social media in late February 2026, with speculation that the legal exposure might force Jane Street to modify or shut down its trading algorithms, something remarkable happened. On February 25, 2026, Bitcoin surged over 3% in a single session. It broke multiple resistance levels. $323 million in short positions were liquidated. ETF net inflows reached $257.7 million, the highest since early February. The RSI, which had plunged to 1580, the lowest reading since the 2020 pandemic crash, reversed sharply. The 10 a.m. selling pattern? Gone. Correlation does not equal causation. Multiple factors were at play. Trump's State of the Union, oversold technicals, short covering. But the timing was striking. And this isn't the only legal trouble Jane Street has faced. India's Securities and Exchange Board, SEBI, banned Jane Street from local markets in 2025 over alleged manipulation of the Bank Nifty index. The regulator described strategies involving coordinated activity between cash markets and options markets to influence index levels and profit from derivative positions layered on top. The regulator estimated billions of dollars in profits over a multi-year period. Jane Street has not admitted wrongdoing in India either. But here's the bigger picture. No U.S. regulator has concluded that Jane Street manipulated Bitcoin markets. The 10 a.m. theory is, as of today, March 7th, 2026, an unverified hypothesis circulating in crypto communities, not a proven fact. What is a proven fact is the structural reality. Jane Street sits at one of the most powerful positions in the Bitcoin market, It has the tools, the infrastructure, and the algorithmic capability to influence short-term price action in ways that are perfectly legal and potentially devastatingly effective for capturing value from retail traders. Whether they did, whether they do, whether they will. That question is still open. Share this with someone who thinks crypto is just about picking the right coin. Let's zoom out. Because the real story here might not be about Jane Street specifically. The real story might be about what Bitcoin has become, and whether that transformation is a feature or a bug. Bitcoin was created in 2009 as a direct response to the 2008 financial crisis. Satoshi Nakamoto built a system designed to remove trusted intermediaries. No central banks, no Wall Street gatekeepers, no authorized participants, no 10 a.m. algorithms, just code, consensus, and cryptography. And for years, that's more or less what it was. But today Bitcoin sits inside a global financial system that includes ETFs with authorized participants who control creation and redemption. Derivatives markets where leveraged positions can be liquidated by algorithmic selling pressure. Institutional market makers who hold structural advantages over every retail participant. A $1.33 trillion market that moves in step with the S&P 500, a correlation that would have horrified Satoshi. Since November 2025, approximately $4.5 billion has flowed out of spot Bitcoin ETFs. The very vehicles that were supposed to democratize Bitcoin access have, in the view of some analysts, created new layers of institutional extraction sitting between retail investors and the asset they think they own. Long-term Bitcoin holders, wallets that have held for over a year, sold an estimated 143,000 Bitcoin during the 30-day period ending March 1st. That's structural selling from the most committed hands. Meanwhile, firms like Jane Street are quietly positioning, buying MSTR, Strategy, formerly MicroStrategy, Michael Saylor's Bitcoin holding company, by 473% in Q4 2025 alone, adding $121 million in MSTR shares while allegedly depressing the spot price. Think about the implication of that. If you can depress the spot price of Bitcoin and simultaneously accumulate leveraged exposure to Bitcoin through companies like Strategy, you are capturing Bitcoin's upside without paying Bitcoin's current price. Is that manipulation, or is that just the smartest trade in the room? Now ask yourself, which side of that trade are you on? Bitcoin was created as a decentralized financial system, a system without gatekeepers, without permission, without authorized participants, without anyone who could sit between you and your money and skim a toll every single morning at 10 a.m. But today, Bitcoin sits inside a market structure that Satoshi never designed for. A structure dominated by firms that trade faster than any human can react. Firms with privileged access to the plumbing of the ETF system. Firms that hold positions so complex, so layered across spot, futures, options, and ETF shares, that even their public filings only show you a fraction of the truth. Firms like Jane Street don't control Bitcoin's supply. They don't control the blockchain. They don't control the 21 million coin limit. But they do control something that, in modern financial markets, is arguably more powerful than any of that. They control liquidity. And in markets where liquidity determines price, and where thin order books at 10 a.m. Eastern Time can be moved by algorithmic sell pressure in microseconds, controlling liquidity means controlling the price that retail investors pay every single day. So here's the question I want you to sit with. Bitcoin was designed to be a system where you don't have to trust anyone. But in 2026, can you actually use Bitcoin through an ETF, through a leveraged position, through the institutional infrastructure that Wall Street has built around it, without trusting Jane Street, without trusting Virtu Americas, without trusting JP Morgan Securities, without trusting the firms who control the 4 slots of the authorized participant structure? That is the question the crypto community is grappling with right now, and nobody has a clean answer. Here's what I know. Understanding how money actually moves. Not how retail investors are told it moves, but how the most sophisticated firms in the world actually position, accumulate, and extract value. That understanding is the foundation of real financial intelligence. And that's exactly what I want to help you build.